How to actually get rich fast from trading. The key to achieving significant wealth quickly through trading forex, stocks, and cryptocurrencies lies in effective money management and in-depth analysis techniques. These methods help identify the optimal price points to enter trades at the right time, avoiding both late entries and premature decisions. This means we enter the market at an opportune price point, offering significant profit potential with minimal stop-loss risk. Therefore, by adopting this method, we aim to enter trades at advantageous prices, potentially capturing the peak of the pullback with greater accuracy. Finding perfect signals like this is quite uncommon, but when you do come across one, it's akin to uncovering a treasure trove. Such signals have the potential to yield substantial profits, while keeping the risk of stop-loss to a minimum. Hello everyone, welcome back to another episode. After 10 years of trading experience, I want to discuss what I believe is the most effective approach to trading. This method involves a specific trading style, a strategy with several key principles to follow. In my view, this approach offers the best and most reliable path for most manual traders. From my personal experience, this has proven to be the simplest and most consistent method for maintaining profitability over time. So, let's dive into it. What exactly is this strategy, and what does it entail? There are multiple components to cover, so please bear with me as I explain each one. Firstly, we need to determine our trading goal so that we can create a plan that optimally positions us to achieve it. When analyzing the chart, the ideal time to enter a short position would be at each of these peaks. Conversely, in an uptrend, the optimal entry point for a long position would be at the bottom of each dip, anticipating a continuation of the trend. Now that we have established our objective, to enter short positions at peak pullbacks in a downtrend, and to buy at the lowest points of dips in an uptrend. So, how can we execute this strategy effectively? And how can we formulate a plan that places us in the best possible position? Well, first of all, we need to determine the trend direction, which is a fundamental aspect of this strategy. A straightforward way to do this is by using a 200-period exponential moving average, a reliable tool for trend filtering. Here's how it works. When the price is below the 200-period exponential moving average, we focus on shorting pullbacks. Conversely, when the price is above the 200-period exponential moving average, we concentrate on buying into dips. Now, let's discuss how we determine the optimal timing for entering a short position during a pullback, or when to buy during a dip. How can we confirm that a dip has ended or that a pullback is concluding, signaling a resumption of the trend? Let's introduce a few additional rules that can guide us in making better decisions. This next aspect comprises several layers, so let's begin with one rule aimed at preventing entries when the price has become overly extended to the downside or upside, depending on the trend direction. Because we don't want to be entering into a long position right at the bottom here before a pullback. Instead, we prefer to enter at a discounted price. How do we ensure that we're entering in at a discount? Here's a suggestion. Use exponential moving averages like the 50-period EMA in red and the 100-period EMA in blue. The rule here is to wait until the price has pulled back to at least the 50-period EMA before considering entry. This helps ensure you're not entering when the price is too far extended from the EMAs. If it's extended, it likely means you've missed the optimal entry and should wait for the next pullback. Having this rule prevents you from entering when the price is excessively low in a downtrend or excessively high in an uptrend. The goal is to enter at a discounted price rather than a premium. Remember, buy at a discount and sell at a premium. So, the key rule here is to confirm that the price has retraced to at least the 50-period EMA before considering entry into the trend. Now, pulling back to the exponential moving averages is just the initial step in this strategy to ensure you're not entering when the price is too extended, aiming to get into the trend at a discounted price. However, it's not wise to enter blindly simply because the price retraces to the exponential moving averages. We need to add more layers to this approach. One suggestion is to use indicators like stochastic oscillator, which can confirm that our entry point is more favorable by indicating that the indicator has fully reset. Fully reset means the indicator has returned to overbought territory in a downtrend or oversold territory in an uptrend. In an uptrend, when an indicator reaches oversold conditions, it often signals a good entry point. Therefore, not only has the price retraced to our exponential moving averages, providing a discounted entry, but the indicator has also fully reset into its oversold territory in an uptrend, or overbought territory in a downtrend. Hidden divergence occurs when the price forms a lower high, but simultaneously, an indicator forms a higher high. Or when the price forms a higher low, but simultaneously, an indicator forms a lower low. We can see an example of hidden bullish divergence here. The price has recently reached a clear higher low, while the stochastic oscillator simultaneously recorded a lower low within oversold territory. This hidden divergence analysis suggests that the market may be sufficiently satisfied to initiate a correction, presenting an opportunity to enter at a discounted price before resuming its bullish trend. Professional traders consider this method among the best and safest ways to avoid entering a trend prematurely, which could result in being stopped out. While losses are inevitable in trading, the goal is to minimize them by entering at optimal discounted price levels. Furthermore, this scenario applies when the price is in a bearish trend. Our objective is to ensure the trend is poised to continue and that the market has identified its premium price point. So, let's delve into this further. Bearish hidden divergence happens when the price makes a lower high, but the stochastic oscillator shows a higher high in the overbought zone. This analysis of bearish hidden divergence indicates that the market is content with the price rise, which has reached a premium level in the current bearish trend, and suggests that it will continue to move downward. Experienced traders see this as a good opportunity to join the market and ride the downward trend, which could potentially go much lower. As mentioned before, this approach is considered one of the most reliable ways to avoid entering a trend too early. Make sure we don't enter the market when the price has already moved too far. Now that we've established the trend direction, ensured we are not entering when the price is already too extended, and confirmed our indicator has reset into overbought territory and identified hidden divergence, let's explore a multi-time frame approach. Here's how we do it. We move to a lower time frame and utilize EMA lines to our advantage. For example, switching to the 1-hour time frame allows us to zoom in and observe all these pullbacks on a smaller scale. For example, 30-minute time frame chart. By using EMA lines, we can identify whether the price has not moved too far or is still too premature for us to enter the market. Let's analyze one of the recent pullbacks I marked on the 1-hour time frame, shown up here. We can use our EMA lines to determine if the price has already moved too far. For example, on the 30-minute chart, we notice the price staying within the range of the 200-period EMA and 50-period EMA on the smaller time frame, in this case, the 30-minute time frame chart. This price positioning indicates hidden divergence signals forming on the 1-hour time frame chart, where the price neither moves too high nor too low. This means we enter the market at an opportune price point, offering significant profit potential with minimal stop-loss risk. Therefore, by adopting this method, we aim to enter trades at advantageous prices, potentially capturing the peak of the pullback with greater accuracy. Finding perfect signals like this is quite uncommon, but when you do come across one, it's akin to uncovering a treasure trove. Such signals have the potential to yield substantial profits, while keeping the risk of stop-loss to a minimum. To illustrate this remarkable signal further, let me share another example. In this example, we observe a higher low in price and a lower low on the stochastic oscillator, which often indicates an optimal entry point in the uptrend on the 1-hour time frame. I find this to be a reliable signal because the price is hovering around the 20-period EMA and 50-period EMA lines. Furthermore, as mentioned earlier, we can check lower time frames to ensure this exceptional signal is well positioned. Not too deep or too early. For instance, in the 30-minute time frame chart, the price is situated between the 50-period EMA and 200-period EMA in a bullish formation. Similar to the previous example, this is a perfect setup for a hidden bullish divergence signal, which typically indicates substantial potential profits, as it suggests the price will continue to trend strongly upwards. However, it's crucial not to overlook the importance of stop-loss orders. Always place your stop-loss just below the nearest swing low to protect your investment. Now, let's revisit and recall our original objective. Our aim was to ensure we short during downtrends at the most advantageous prices, particularly when prices are discounted. During these pullbacks, our strategy focuses on shorting at peak levels to align with the downtrend. I believe the rules we've compiled now effectively secure optimal entry points during pullbacks. Naturally, not every trade will be profitable, but these rules tilt the odds in our favor by maintaining a good risk-to-reward ratio. This approach allows for profitability over a series of trades. Next, let's discuss setting profit targets and placing stop-loss orders. This relates back to our initial goal of entering trades during downtrends at discounted prices and anticipating further movements in that direction. Therefore, our profit targets should be set in accordance with this objective. So, let's say you've entered a short position during this pullback. In my view, the profit targets should at least reach the low point before the pullback started. As a trend follower, you anticipate a complete continuation of the trend, expecting a lower high, followed by a lower low. Therefore, your take profit target should be set accordingly. Regarding stop-loss placement, I recommend using a risk-to-reward ratio of at least 1 to 3. This example is set in a market that is trending downward, focusing on short positions. However, the rules apply similarly in an uptrend, just in reverse. In an uptrend, instead of seeking bearish hidden divergences, you would look for bullish hidden divergences. The same principle applies to your stochastic oscillator and exponential moving average. You can verify the effectiveness of this strategy in forex, stocks, commodities, and cryptocurrency markets. The key is to maintain discipline with the trading rules outlined in this strategy. Setting up the EMA and stochastic oscillator indicators for this strategy is straightforward, making it easy to implement. Alternatively, I've included a system template in the video that you can easily apply to your charts. This template automatically plots all the necessary indicators accurately, eliminating any concerns for you. You can find the download link in the video description. Finally, while this is a highly effective and reliable strategy, there's no guarantee that the trading signals generated will be 100% accurate, because no human, institution, or tool can predict exactly where the market will move. Everything is based on probability. Therefore, no strategy can promise 100% profitability all the time. That's why it's important to always implement stop-loss orders to protect your funds. As always, if you learned something new, or if you want more videos more often, make sure you subscribe, click the notification bell, and share this video across your WhatsApp, Facebook accounts, or X to show your support. See you next time.